Everyone, welcome to this video lecture, and today we'll study some smart money concepts. Smart money concepts were made to tackle institutional orders for retailer traders. Smart money concepts tell you the entire picture, what's happening in the market. They tell you the macro picture. They even can gauge the news. They can even tell you the dynamics. So it's a multiple tool frame. So we'll study them today. So I will just name the terminologies. The basic two tools which were also framed by ICT in a circle trader are liquidity pools and fair value gaps. And inverse fair value gaps. These were the two basic things. Then he conceptualized on order blocks. Now, other thing that comes is change of character and break of structure. There are many factors other than these as well, but for this video, we'll focus on these five. So it's in live market, trading on S&P 500 futures. Liquidity pools. What are liquidity pools? You take the lowest of the lows in a sequence of candles on a higher time frame chart. These can also be plotted on 1 minute chart or 1 day chart or 5 minute chart, but you begin with the higher time frame. It's called as multi-time frame study or top to down approach. Smart money analysis also works in zones, demand and supply zones. So I forgot to mention that earlier, but we will study them today. So these two things. This is Buyside liquidity. And this is Sellside liquidity. Liquidity pools are the places in the market structure where people have placed their stop losses. Retailer traders, especially because they work on resistance and support. Most of them, out of let's say 100% are retailer traders, 65 or 70% retailer traders work on resistance and support. So they have marked their stop losses here and gone long. In process of going long, there are other traders which are facing their this is the resistance point. If it comes at place here, I will short and the stop loss would be above this. So ICT conceptualized that these stop losses places are the ones which are targeted by institutional traders. He hypothesized and he proved his point very correctly. So at these places, there is large pool of trades that get triggered due to incentive stop losses for the algorithm, and these are the places where market structure gets very fast, very fast place of inflow comes. For to match those orders, institutional inflow comes, and institutional inflow goes in the other direction rather than going in the resistance or support line. It goes in the other direction. So I cannot show you live right now because these are weekly charts, but keep in mind these levels. When I'll go on the, let's say, 5 minute chart, if you go, this was according to retailer trader, this was a major support line, and see how it broke down because institutional traders attacked the support line in places of where people must be buying or selling their stop losses. They made the selling supply higher. It's very easy to grasp if you put your mind to it. This was supposed to be a resistance line. The price went up before the liquidity pool and reversed. When institutional trader feels that they have placed their stop losses above this point, or they have placed trades above this point for going short, they do the opposite of it because order matching won't work and price would be consolidating at those levels. Another concept which is of fair value gap. So let's go back on higher time frame and analyze daily chart. This is a daily chart. There is one small fair value gap which is converting into an in inverse fair value gap now. It got the market up twice. Market went up. These are daily candles. So market went up twice in this structure. But now it might be acting as an inverse fair value gap, or it might react again. So we have to study that. How do you study that? Every rectangle has a middle line, right? Once the price crosses below the middle line, it is going to act as an inverse fair value gap. If it does not cross and it reacts in the other direction of middle line, it is a proper fair value gap. Middle line is the benchmark that you follow. This will be more visible to you if I go on to 30-minute chart, and middle line is about to face a rejection or an acceptance. There is another fair value gap formation. This is supposed to act as a resistance point because it is well above the market structure and it is gonna give the edge of facing a directional move towards a reversal side. So that's how it works. If price doesn't cross below the middle line of this daily fair value gap, it will go above this level because fair value gaps are inefficiencies, and inefficiencies act as a magnet form. They attract the price towards them. you see this wick, then hardly any price action went above this wick. The wicks acts as resistance point as well. This is also a smart money concept. While we wait for the reaction, we should study character of change, break of structure, or order blocks. This place near the fair value gap and a green candle is an order block for prices to go above. It will block those orders in place of it will act as a resistance point. While price is in premium or discount, if a discount green candle gives you some symphony that it will react in other favor, then it won't. If price is down, the premium order blocks will work. If price is up, if price was here, then a discount order block will work. An order block has to be built near the fair value gap. That's how we conceptualize an order block. Let's see it on a 2-minute chart. See, price is in discount right now. What's premium and discount? Discount is below 50% of the price action. Premium is above 50% of the price action. How do you calculate it? You take the top of the price action and you build a Fibonacci fib. You place, you reject, you reverse all the other points and you just take 0.5, 0, and 1. So this is the line which segregates premium and discount. So for example, this order block will act as a resistance point because it's also near a fair value gap and it's a green candle. So we understood fair value gaps, order blocks, and liquidity pools. Now it's time to study character of change. Sorry. You see this high, price went below, facing this high, and then it went up. It's a linear regression curve line. Price cannot go above this high. Price rejects this high again and again. That's the conclusion. So where did we see the break of structure? We saw the break of structure at this point. The nearest high, a wick having the nearest high and price going above the nearest high. Change of character would be done if price went above this high, which is a solid high or two equal highs, it occurs. So thank you for watching this video. I shall see you soon.